Is America's banking system about to fail? If you've been paying attention to current events, you've probably heard about Silicon Valley Bank and maybe even some of the other small banks that have gotten themselves into hot water. In this video, I'm going to talk about what happened, what the Fed responded, and in this video, I'm going to talk about what happened, what was the response, and what you should do or consider doing next. Let's get into it. Welcome to The Wealth Technique, the channel where we help you build, protect, and transfer your wealth. My name is Michael Baker, and today we're going to talk about SVB, the Silicon Valley Bank situation, and everything that so far we have been able to gather about that. I did not want to go ahead and do something over the weekend as a lot of these events were unfolding because personally, I like to not be first. We live in an age today where so many people want to run with information and be the first to quote unquote break news. I'd rather take a little bit of time, try to get some facts about what's actually happening, and then put out a reasonable response. Now, before I get started, we have to make the attorneys happy. We have to make compliance happy. I am not a banker, and I do not know, nor do I wish to know all of the various intricacies of the banking system and how banks operate on a day-to-day basis. I would venture to say that the vast majority of us are not bankers either, but when something goes wrong with the bank, it definitely gets everyone's attention. So let's talk a little bit about what actually appeared to happen with Silicon Valley Bank. First of all, I think it's important to understand what this bank was. In fact, it appears to be that Silicon Valley Bank was a bank that was highly favored by the tech sector, by venture capitalists, people that are in, technology industries in general. And those people represented a significant, if not the vast majority of the deposit base for Silicon Valley Bank. So if you've paid attention over the last year, the Federal Reserve has gone through almost an unprecedented rate hiking cycle where we started the year last year at a 0% federal funds rate, and we ended 2022 at very close to almost a 5% rate. It was a significant tightening when it comes to the federal funds rate and the quantitative tightening that they were doing. They were trying to really strangle capital conditions and get a stranglehold on inflation that was going on in our economy. So that was what was going on. That was the backdrop for a lot of this. And in my view, that was the setup for what transpired. So that was going on in the background, and industries like the tech sector, you've seen there's been a significant drawdown in the value of cryptocurrency, crypto assets, any industry or people that were involved heavily in that type of sector, technology. Those businesses have been really hit hard because as the cost of capital gets higher and higher, loans become more expensive. It becomes harder to fund businesses that may be risky, where you could potentially lose all of your capital, which is how venture capitalism is supposed to work. It's supposed to be, super high risk, but also super high reward. And so the funding has been kind of drying up. And what's happened is a lot of those companies, they took their money and they went and parked it in entities like Silicon Valley Bank. In fact, I've read articles where it said this was the bank of the tech startup sector. And so a lot of these companies have been having to draw down on their deposits or need their deposits to continue operations because funding has dried up in a lot of cases. So Silicon Valley Bank has been seeing heavy withdrawals on their deposits. In the meanwhile, their deposits had really grown significantly. And so let's think about what banks actually do. This is something, and if you've talked with me personally, I am not a huge fan of over-regulating just about any industry. I think markets can often regulate themselves. I think guardrails are a good thing, but I think we have a tendency to over-regulate when things happen. And there used to be a provision called the Glass-Steagall Act that was repealed, and that created a wall of separation between like banks and more, financial institutions like investment banks and investment providers. And now a lot of banks provide investment services. So there are everyday people who go and they, are using a bank for bank services, but that bank is also involved in other operations that could create risk for it. So in this case, Silicon Valley Bank's taking on lots of deposits. Things are good in the boom times, and they don't necessarily loan out all of those deposits, right? So the banks start building their own portfolio. Well, when banks do this, they can designate assets in their portfolio as assets for sale, or they could designate them as assets that are held to maturity. And there is some flexibility with how those assets may be designated. So in a case where we are having a drawdown in the overall stock market, and maybe even bond portfolios are going down because of the Federal Reserve tightening interest rates and bumping rates up, those assets can become very volatile, and they can create losses on a bank's balance sheet. And so banks have the ability, if they wish, to take assets that are assets for sale and move them to a held to maturity status. And apparently, these assets that are designated as held to maturity do not have to be reported as losses on the bank's capital position on their balance sheet. They are reported, but they're not, they're designated as held to maturity. And generally speaking, the bank is saying, hey, we're going to hold these assets to maturity. Well, in this case, Silicon Valley Bank was holding a lot of mortgage-backed securities. And if you recognize that term from 2008, it became synonymous with pain because mortgage-backed securities were an issue from 2008. But apparently, these securities that they were holding were fine. They were just at very low rates. So if you have fixed income assets with an interest rate or a coupon rate that's very low, and rates in the overall market start to rise and pass the coupon rate of what you own, you start taking losses, because if you were to sell that position, you would need to sell it at a discount. Well, that was what's happening to Silicon Valley Bank. And so essentially, from what I've been able to glean, and I will make sure that in the comment section or the notes to this video, I post multiple links of the things that I've read about this situation, so you can see my source material, and if you feel so inclined, you could fact check me as well. But basically, they were notified, Silicon Valley Bank was notified that they were going to have to potentially see a downgrade from Moody's because of some of these losses that they were receiving in their portfolio. And then that triggered them to want to raise capital. Well, the people that put their money there heard that the bank was wanting to raise capital, so they started to pull out their deposits. And this is one feature of this bank run that I don't think was well thought through from regulators. How do most people bank today? We bank digitally. We use one of these. And so most people, if you're like me, you take your phone out and you do a lot of your banking. Well, the quickness with which withdrawals were happening from Silicon Valley Bank was apparently way faster than they can get underneath. And so the more people withdrew money, the more it hurt the capital position, couldn't raise money, and essentially the FDIC stepped in and took things over on Friday. So there you are this weekend, walking into the weekend on Friday and Saturday and finding out that one of our largest banks in the country is being taken over. Now, I think it's very important to designate that this bank was a large bank, but this is not a bank the size of Bank of America or JP Morgan. It was not one of these systemically important banks that we all learned about from the financial crisis. However, it is definitely very alarming when anytime the FDIC steps in and takes over a bank. Now, here was the problem. Okay, here was the big problem with SVB. So if you understand about banking, and most people have a general working concept of understanding what FDIC insurance is. So the FDIC insurance is basically, if you put money on deposit at a bank, they're saying, hey, if there's ever a problem with the bank, we will step in and secure this deposit up to the insurable amount, which is $250,000. That's a lot of money for your everyday person, but for a business, $250,000, especially for venture capitalists or startup companies, $250,000 is not that significant. And so there was a piece that I read from Mark Rubenstein, who writes a newsletter on Substack called Net Interest. So Mark Rubenstein says that in bold, he says that customers with balances greater than the FDIC amount accounted for 157 billion of Silicon Valley's deposit base, holding an average of 4.2 million on account each. Now, this explains why, if you're on social media like me, this explains why many of the venture capitalists and the people in Silicon Valley were screaming bloody murder on Twitter or on their social media channels all weekend. I mean, they were in full-blown panic mode because obviously if the FDIC insures $250,000 and you've got $4 million on deposit and that bank is now insolvent, you might be in real trouble. And personally, I think that's really dumb. But at the same time, it begs the question, like, well, what should we do for these companies that are in startup mode? They have huge capital bases and they need access to a lot of cash because they're hiring, they're trying to scale, they're doing lots of things, and they can't necessarily take that money and sprinkle it among 20 different banks. What should they do? I think that's a great question for regulators and how that should be handled. So that's number one. But other things that I have learned about this situation is apparently Silicon Valley Bank, their chief, according to Mark Rubenstein, their chief risk officer left the bank in April 22, and they did not replace that person until January of 2023. So this bank operated for almost a year without their chief risk officer. So I think maybe there's some internal stuff happening that should have been taken care of a long time ago. And then, secondly, or lastly, I should say, apparently this bank did not have any hedges on their portfolio positions. So a hedge is essentially say, hey, we're going to take a position here, but we're going to limit our losses or essentially prevent our losses from going past a certain point. Well, apparently they didn't do that at all. So I feel from what I've read so far, there definitely looks like there was some significant mismanagement when it came to how this bank was handling their balance sheet and their financial position. And it's possible that we could see some people getting into some hot water because if you're operating a bank on this scale and you don't have a chief risk officer on staff, it makes you wonder like what could have potentially been avoided. So basically that is my best understanding of what's happened with Silicon Valley Bank. Essentially the bank was doing okay. They were technically insolvent when their mark-to-market positions were underwater over their assets, but they would have been fine if there hadn't been a bank run. And essentially, this sounds like the tech sector essentially orchestrated a bank run on their bank and basically forced them into being taken over. Now, here was the controversial point that many people were waiting to see because, as I told you, a lot of the VCs were on their social media channels just screaming bloody murder over the weekend, saying that this was going to be a collapse of the banking system and the Federal Reserve better step in immediately, all of the things. Well, that was the big story. Well, what was the Treasury Department going to do? What was the Fed going to do? How were they going to come in and rescue this bank and, of course, protect the depositors, which I've already told you they had $157 billion on deposit. And it says here in this article of its total 173 billion on deposits at the end of 22, 152 billion were uninsured. So there's lots, in my view, there's lots of irresponsibility to go around. It's just now who's gonna actually have to pick up and carry the water. So the Federal Reserve, the Treasury Department, and the FDIC stepped in and issued a joint statement that said that the depositors would be fully backstopped, essentially crisis off the table. That's my view. Crisis off the table. The Federal Reserve, the Treasury, and the FDIC are stepping in. Now, there are a lot of people that are very, very upset about this because they feel like this is essentially a bailout, just like we did back in 2008. It's a bailout. And whether you fully take that position or not, you have to also think about, to me, is what this could potentially snowball into. And so the term that's often thrown around is the contagion. Like what could this one instance, if we let this bank fail, then what happens? And never mind, we're in the middle of still trying to, get inflation under control. A lot of the economic data we've have been watching or seeing has been softer, and there's calls that we may be, seeing a recession coming. It's still debatable whether or not we're going to be able to see quote unquote a soft landing or not. And then, oh, by the way, now we've got banking issues. Probably not the time to take a hardline stand and saying, hey, you know what, you flew too close to the sun and you've got to take your medicine. Do I like it? No. Is it probably the right thing to do in this circumstance? I think so. Because what happens is you take one issue like this that may be symptomatic of a bigger problem, and if you don't deal with it, you create the bigger problem because, as we all know, people are not necessarily the most rational at times. And when people start to think that their banks are in trouble, we could see bigger issues flower out of this, and we don't want that to happen, especially with everything else that's going on. So that's what happened. They stepped in. They've created a new entity called, I think, the Bank Term Funding Program. Gotta love the acronyms. A lot of people now say that this basically means, we have FDIC to infinity. Who knows? Who knows? What I have learned is that when government programs come into the place, they tend to stay. They tend to be, there's nothing so permanent as a temporary government program. I can't remember who quoted that, but that seems to be pretty much how things operate. So I'm sure that there will be other issues that arise out of this, but that's essentially where things are at. Now, here is the last domino that I think could potentially fall is now that everybody has seen the blueprint for how banking can operate, and a lot of these banks are holding significant losses in their held to maturity portfolios. What type of scrutiny will other banks fall into? Just today, Credit Suisse was potentially in trouble, and there were a couple of other banks that are going to be looked at. So my belief is we'll probably see some other banks, smaller banks likely, being scrutinized heavily by these assets in their portfolio that they've been holding. Now, hopefully, there's been some better governance with some of these banks, and they've hedged their positions, and they have their chief risk officers intact, and they've been able to get some good leadership at the bank leadership level. But my guess is we'll probably see a few other things. But I do think we're not going to see this massive bank contagion take over. So I'll end with this, like what you should do. A lot of people, anytime we see something that we tend to take for granted, like the safety of our banks and our money that we're holding on deposit, what we think about, like, what should we do? What should be prudent? Well, first is understand that the FDIC limits do exist. Now, I've always taken the position that the FDIC is somewhat of a paper tiger in that if the FDIC can't come in and we do see bank failures and they can't, true people up, the likelihood is that we will see the government swoop in and backstop those investors. And here's our litmus test. We just saw it. So I don't like it, but I do think that you should be prudent with your own funds. So the first thing I would tell you is, look at where you're banking and understand, are you reaching for yield? Are you with, kind of a bank that you don't know much about, but you found on the internet, but they were going to pay you, 3% more than, a traditional bank on your deposits? It might be time to evaluate that relationship. Number two is, I think that if you are holding funds on deposit at institutions where you've got large deposits significantly over these FDIC limits, maybe it could be time for you to find a separate bank, find a different bank, or look at the titling of those accounts to make sure that you are at least adequately insuring yourself to the extent that you possibly can. A lot of people that have investments and that, they're thinking about what's going on and how might this affect the stock market. If you're working with a financial advisor or you're working with a financial planner, if you are uncertain about things or you are uneasy, please reach out to them. That is part of the job. That is part of our job as advisors, is to be there when times get tough, when things are turbulent, and there's uncertainty in the air. Please reach out, just let them know, hey, I've got these questions. That's part of our job, to talk you through. If you need to sit down, review your plan, review how you're investing, I encourage you to do that. The last thing that I want to leave you with is, please do not do anything. Please do not do anything rash or irrational at this time. One of the most common things that happens anytime there's scary headlines in the news, anytime there's something that's going on, there are scam artists, salespeople that will pounce and want to capitalize on fear in the marketplace. And they'll want to tell you things that, oh, you shouldn't do this with your money. You should do that because your money's not safe there. Do not do anything irrational. If you're going to do something, think it through. Don't make a decision based on fear. Think about what your overall financial goals are, what your objectives are, and make those types of decisions in the context of a financial plan. I'm all for protecting assets. I'm all for using assets in safe manners, and not to get outside of your comfort zone if that's who you are as an investor. But I think even my conservative folks need to have a plan, need to have a strategy for how you're allocating your capital. Don't get on social media and listen to people who have no credentials. Don't get on to the cable news networks and let them scare you half to death into making decisions about your money. Reach out to a financial advisor, reach out to a competent financial professional, someone that can help you, guide you through those decisions, and you can make good quality decisions for yourself. So thank you guys for tuning in. I hope this was helpful for you. For those of you who joined me, I really appreciate it. I'm going to kind of break character now, if you will, and be happy to take a few questions if anybody throws anything up in the chat. Otherwise, I'm going to bounce and let you guys get back to your day. All right. So not seeing any questions coming through. Maybe your thumbs aren't fast enough, but thank you guys for tuning in for the office hours. I am going to do these more consistently. I'm working with my calendar right now to try to figure them out. But in the meantime, if you haven't, please take a chance and subscribe to the channel. That helps people find my channel on YouTube. Thank you for tuning in, and I appreciate you guys so much. Have a great day.